Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management Firm. That's the investment firm, Wilsey Asset Management. Well, we got a great show lined up for you. You know, and Chase, each week it gets harder and harder. We got so many great topics to talk about. We only do 3 here on the podcast radio show, but at our website, smartinvesting2000.com, you can see the other ones. But the 3 that we chose to talk about on today's show is investing in Google's Century Bond a good idea? And again, it's a 100-year bond. Is that a good idea? We'll talk about that. Big expenses are coming for companies that invest in AI. It's not a free lunch. We're going to talk about those big expenses and how it's going to be hurting them. And don't blame the restaurant or the grocery store for the high price of meat. There's things going on way before that. They're not gouging you. That's just what's going on in the industry. So we'll discuss that and why you pay $40 to $50 or $50 or more for a steak.
Yeah, some places I know it's quite expensive. But outside of that, we're going to talk about our companies as normal. We're going to look at Mattel, the toy manufacturer, also to DraftKings, Ferrari, and restaurant brands. As always, got a full show for you here. We're going to break down the fundamentals, give you an idea if we think it's a buy, sell, hold, based off the numbers we see here on air.
All right, well, let's talk about the first one is don't blame the restaurant or the grocery store for the high price of meat. I'm sure you've noticed if you want to go out and have a good steak, you know, you're probably going to spend somewhere in the neighborhood of $45, $50, maybe even more. We went to a restaurant the other night. I think it was called Abilene, I think it was, or Abilene. Gosh, I should have gone before I went on there. but we just went there Wednesday. Yeah. I wasn't really that impressed, to be honest with you. But I mean, they had a steak on there for $265. Oh. Yeah, and it's just like, wow, that's pretty pricey. But depending on the restaurant and how big the steak is, I mean, obviously, get a 6 ounce versus 16 ounce, the price will be different. There's a big shortage of cattle in the United States, and the numbers, well, I got to tell you, they're staggering. In January, there's only 86.2 million cattle and calves, which is down from the peak of more than 130 million in the mid-1970s, over 56 years ago.
I mean, that's just crazy because the thing you have to look at here is the number of people in the U.S. now far surpasses the number of cattle. And supply and demand being what it is pushing the price of cattle to higher levels. Obviously, I'm just going to say you have more people, that most likely is going to lead to more demand, and then you have less supply. That's a mismatch. That's a problem, and that's why we're seeing, again, those higher prices for cattle. The 86.2 million heads of cattle may sound like a lot, but when you look at the numbers, it is the smallest herd since 1951, and that's when the population in the U.S. was 157 million people. The population, well, that now stands at around 344 million people, which is an increase of 119%. All things being equal, there should be somewhere around 188 million heads of cattle available to kind of create an apples-to-apples comparison back to, again, 1951. So we're at about a shortfall of 100 million cattle.
I was going to say, we're not even halfway there what we should be. And there's 3 main reasons why the price of meat is high and the number of cattle is so low. We used to receive about 5% of beef supply from Mexico, but a parasitic fly, larva called screwworm, and it has really screwed us, has destroyed that supply. Another problem is a lack of rain in Texas, which is the largest producer of beef supply with 12.5 million cows in Texas alone.
Yeah, and if ranchers, they don't get enough rain, they produce smaller herds because the cost of feed increases. You may be thinking there's a lot of cows in California, and yeah, you'd be right. You know, you see them driving along the 15, you know, you see it's like, wow, there's a ton of cows over there. But the thing that you look at is about 1.7 million of those cows are dairy cows compared to a total population of about 5 million cows here in California. So we're looking at, again, a large portion of those cattle being for dairy rather than for consuming beef.
Yep. And I know driving up Interstate 15, you drive up there, and I forget where it is. It's not quite in
Bakersfield.
Bakersfield, I think. You looked at it like, wow, all these cows. But I think those are, as you say, I think they're all milking cows, not beef cows.
Yeah, and I mean, looking at it too, I mean, California is the fourth largest producing state for cows, but again, it's not all for beef.
Yeah, yep. So I think the other two were, doggone, I forgot. I think
Probably like Idaho or something.
no,
or
Oklahoma. I think it
something?
was,
Oh,
and
yeah, that makes
Nebraska.
sense.
I think
Okay.
Nebraska. We got two.
Not Montana, huh? Not Yellowstone.
No, they got bears there.
Yeah, I guess.
Well, the third reason is simply because being a rancher, it's hard work, and is generally passed down from generation to generation. Now, most kids, when they're growing up, they do not dream about working on a ranch in the hot sun and in the dirt all day long. Also, the price of land. Some ranchers realize they're better off selling the ranch for big profit than continuing to work the land or the farm. Fortunately, many ranchers love what they do, and despite the hard work, continue to do it generation after generation. If you know any young kids that like riding horses and being outside, maybe they should consider going to work on a ranch and save all that college money that they'd spend $80,000, $100,000, go work on a ranch, and I think they get paid pretty well.
Well, I mean, they have to, right? I mean, you're able to kind of sell these cows for more now because the supply and demand. So I'd have to assume wages have increased in that field. I, again, haven't looked at it specifically, but again, I'm making an assumption here based off of prices increasing.
Maybe we need to do a trip to Texas and go visit a ranch and find out, what the deal is right at the ranch there. But
Maybe, yeah. I mean, yeah, obviously Yellowstone kind of fabricates it, makes it look kind of fun and stuff.
Yeah.
So, maybe some people get into it like, this is going to be so fun. And they're like, wow, this is not what I thought it was going to be.
I'm sure it's hard work. I mean, and what companies will benefit from this, from what I can tell, is the processors, the meat processors, and that would include Tyson. There's another smaller company, I forget who it was. Tyson is the biggest one. They do chicken, pork, and beef, because as the price goes up, their percentage goes up. So, but they need to produce more. And again, it's the rain situation.
Yeah, well, and I don't know exactly how it works out because, the people that are buying the cattle and then selling the beef, their margins can get compressed. So, I mean, ultimately what we need is, again, we need more cattle here. And I'll tell you, I'm not going to eat less cheeseburgers. I'm not going to eat less steak. I mean, that's my favorite go-to, and I can only eat so much chicken. I've really pulled back on pork. It doesn't make me feel that good.
Really?
So I like to eat chicken and beef. But the problem is, again, beef is just getting so darn expensive.
And, an interesting side note, in the industry, cattle rustling, where they steal the cattle, that's a big problem as well. But what happens, they steal it. And like if you steal like somebody's watch or something, you can't get a good price for it. They say even the people, when they steal the cow, they still get about the same price as if they had raised it. So that is kind of a problem, because as a rancher, like, well, they're stealing my cattle and I can't sell it myself. So that was pretty interesting as well.
Interesting.
So let's talk about investing in Google's Century Bond. Is that a good idea? Well, if you don't want to listen any further and just want the answer, for investors, I will tell you, it's a terrible idea. Don't do a 100-year bond. On the other hand, for companies, universities, or governments, issuing a Century Bond, again, that's a 100-year bond, is a great way to lock in low rates for 100 years. And as I said, for investors, it is a terrible idea. Here's an example. In 2020, the Austrian government issued a Century Bond, I love this, locked in a yield of 0.85%. Wow, what a great deal for them.
I just, who would buy that? Like, I just can't envision anybody being like, wow, making 0.85% for the next 100 years, that sounds like a good deal to me. And when you look at it, those investors that did purchase the bond, well, they're kicking themselves now. It's now trading for 30 cents on the euro. Another example of how things can change is back in 1997, J.C. Penney issued a 100-year bond. Back then, no one would have imagined bankruptcy would occur just a little over 20 years later for the company. And again, that's the thing you look at, right? Everybody's like, oh, J.C. Penney. Back in 97, J.C. Penney was humming. It was a go-to company. I mean, nobody would have thought they would have gone bankrupt. Here we are today, obviously a few years later, and J.C. Penney is a bankrupt business.
And 100 years, that's more than a lifetime.
Yeah.
I mean, and you just can't predict out that long. So you may be wondering, well, who would benefit from buying these bonds? Well, generally, it would be your insurers or your pension funds, because they both have dated liabilities or they both have dated liabilities. So
Long-dated liabilities.
Long dated. I don't know.
Yeah, I
Long
mean,
dated.
you
Yeah,
have all
long
these.
time. Yeah. So the long bonds do give them comfort, knowing that the future cash flows will be there for them, and that's why they do it. There are also likely to be some hedge funds and high risk investors that will want to trade the bonds as they have a high amount of fluctuation based on the interest rates and the duration of these bonds. I mean, that's who's doing it, is trading. And we know trading short term, yeah, you might get lucky for a year or two, maybe 5 years. But eventually, we've talked about trading, how risky it is in equities. Same thing with bonds. You can't predict interest rates. And again, but that's who's going to be doing it. That the bond, that's 35 cents on the dollar. That's probably being traded a lot.
Oh, I'm sure it is. Yeah, it's more of a trading tool now than an investment, I'm sure. Which is funny because a lot of people wouldn't view fixed income as a speculative asset class, but it can be.
Oh, can be. Yeah, I remember Bill Gross on the PIMCO funds. He did pretty well for years.
Yeah. And the thing you have to understand is in fixed income investing, there's something called duration. You kind of alluded to this, but what this essentially means is it's looking at the numbers of years it takes to recoup a bond's true cost. The longer the duration, the more price volatility for the bond when it comes to interest rate moves. Ultimately, for the average investor, I would say to stay away because predicting, again, as you said, which way interest rates are heading can be a very difficult game, and it can destroy your investment returns. Kind of giving you an idea, right? I'm just going to make the numbers easy for me. If you have a 2-year bond, a 10-year bond, and a 100-year bond, and they're all just, for simplicity, trading with a 5% yield. Well, what that means is if rates were to go from 5 to now 6% on those various instruments, the 100-year bond is going to get hit the hardest compared to the 2-year, the 5-year, and the 10-year. So that's kind of where you don't want to play on those long-dated durations because you could lose a lot of money, and you can hold the bond to maturity if you want, and you're not going to lose any money. But shoot, I don't know about you. I'm not going to stick around for 100 years to get 0.85%.
Yeah, and you're younger than me. I mean, gosh, I have to live to be, 170? I mean, that ain't going to happen. And the thing, too, that what investors would want to do is if interest rates were extremely high, like back when gosh, I remember when it was the 80s, we had rates go up to
70s, 80s. Yeah,
70s,
because
80s.
inflation was the 70s, and then they spiked them. So I
spiked
think
them.
the mortgage rates were, like 13, 14%.
So if you could, at that point in time, if you could lock in, we'll say a 10, 11%, 100-year bond, that'd be a great thing. However,
I mean, maybe, depending on the entity, I mean...
Well, that's what I was going to say. You're going to take the words out of my mouth, because I was going to say, if a company is paying that high interest rate for 100 years, it could eventually cause them to go bankrupt. And, well, sorry, you only got 5-10 years out of that. So it can never really be in a good situation, because you want the company to have lower expenses, lower interest rates, which is bad for the investor. Investor wants higher interest rates locked in, bad for the company.
Or businesses change. I mean, it's not even maybe the interest expense being problematic. I mean, you look at JCPenney, they didn't know Amazon was going to come along and just totally wipe out all the sales and, have that digital, I'm going to call it monopoly, and really change the way retail functioned. I mean, I don't know what's going to happen with Alphabet. I like to think they'll be around for another 100 years, but who knows? There could be some new business that comes in, totally changes the way things operate in their specific, industry, and then all of a sudden Alphabet goes bankrupt. And you, as an investor in that fixed income product, you lose all of your capital. You got the interest payments along the way, but all of a sudden that, principal payment that you're supposed to get 100 years down the line, you're not getting that back.
And I know the president has talked about, for the United States, not heard it lately, but he has talked about maybe the United States should issue a 100-year bond.
That would have been a great idea back in 2020.
Oh, yeah, great idea. But who was
Or
president?
21.
Yeah, I don't think they would have done it back then. But it would have been a great idea for, again, the government. But, now, and it's
That
not.
would have been 2020 because that's when rates really got cut. And,
Right.
The 10-year treasury fell to 1%,
Yeah.
So
2022 is when they started going back up.
Yeah, so if they would have locked in a 100-year bond, let's say at 4%, I mean, that would have been a great deal for the government.
Yeah, that's for sure. Well, let's talk about big expenses are coming for companies that invest in AI. And that we know AI, that's all you hear about, how great it is. But there's a story behind it. And we've talked about this in the past couple of years. And now, after companies have spent roughly $500 billion, that's just in 2025, it is estimated they will spend another $3 trillion by the end of the decade. Now, as the companies spend more money on data centers, chips and other items for AI, their depreciation expense will continue to rise each year, which will reduce their income. And this is something people don't think about. Who thinks about investing? Oh, what's the depreciation going to be? They don't think about that.
Yeah, and the way I just kind of want to break this out for people is let's just, again, look at $100 billion capital expenditure that you depreciate over 5 years. So that would be a $20 billion expense on the income statement. Let's say you do $100 billion this year and then you do $100 billion the next year. Well, now all of a sudden your depreciation goes from 20 to 40 billion. Well, then if you do another 100 billion the following year, now it's $60 billion of expenses that are going to be there for 3 years and then it's going to start to fall off again. It can be a really dangerous path. I kind of almost look at it like these buy now, pay later things.
Yeah.
Right? Where people will stack, oh, it's only $10 a month. Oh, it's only $100 a month. And all of a sudden you stack 10 of them and you're like, oh, shoot, I got $2,000 a month.
Yeah, I can't pay my bills.
I'm kind of looking at it the same way with these depreciation expenses. Like, oh, it's not a problem in year one. Not that bad in year two.
And
year
I think,
3, it could be a big problem.
And I think you were generous with a 5-year depreciation schedule because actually I think on chips it could be a shorter time frame because technology moves so quickly that those chips in 3 years, like, no, we need to replace those chips because they're only a third as fast as the new ones coming out.
Well, but that's the issue. We've talked about this before. This is kind of a different topic, but when you look at the depreciation schedule that these companies are using, it is longer than I think it should be. So they might be depreciating, and I forget the exact numbers, but I think it is over 5 years. But the investment cycle might only be 2 to 3 years. So they might have depreciation on the books and then also need to replace those chips so they're going to have a new depreciation schedule. I mean, it could be a big problem if they're, again, continuously having to replace this chip cycle.
Well, that kind of brings me to the next point because the big tech companies, well, they're kind of sneaky currently with depreciation. Many companies like railroads and other companies report depreciation as a standalone operating expense on the income statement. So you can see it. We look at it. Yep, there it is. But what happens with the companies is that the depreciation is important for investors to understand and is that eventually equipment will become obsolete or worn out and must be replaced. But, and this is a big but, the tech companies currently don't have to break out depreciation until 2028 after a new rule change takes effect. So it's a problem because you can't find a depreciation and you got to wait now to 2028. I mean, and 2 years away to really get some good numbers. And I don't know how the tech companies got away with this. I thought all businesses had to do it, but tech companies.
By 2028, that depreciation is going to be huge if they keep on these massive capital expenditure cycles.
Yeah.
And currently, kind of to your point, they include depreciation in the cost of goods sold or sometimes in research and development or general and administrative expenses. So it is a little bit more hidden there, which makes it very difficult for investors and analysts to understand the true numbers. The big tech companies' defense is they currently include it in the footnotes. How nice of them. However, companies like Microsoft have as many as 15 to 20 footnotes, which are generally not seen by investors or analysts.
Yeah, it's just a crazy thing. And perhaps the big tech companies will continue to hold on to their lofty valuations for now. But at some point, the real earnings will come through, and the stocks, well, they're going to take a beating because, and they've already kind of started to, because it used to be they were low capital expenditures, like, oh, this is great, they have all this cash flow generating. Now all the money they're spending, they're starting to act like a real company to where maybe they won't trade at 20, 30 times earnings because, no, you got capital expenditures, you got depreciation, your earnings have fallen, you're only worth 10, maybe 15 times earnings.
Well, there used to be free cash flow machines, and now with all this CapEx, I mean, some of them are actually tilting towards negative free cash flow. Earnings are still positive, but free cash flow is negative because, again, the way the accounting works behind it. And the thing that I continue to claim is somebody's wrong here, right? NVIDIA is a big benefactor from all of the spending that's taking place. But if these companies continuously have to lay out $150, $200 billion a year in capital expenditures for the next 5, 10 years, they should not be trading at the multiples they are. If the capital expenditure cycle is only maybe 2 to 3 years and those NVIDIA chips are good for 5 years, well, then what happens in 2 to 3 years? Companies don't need to buy NVIDIA chips at that same degree, and then NVIDIA sales will tank. Then they shouldn't be trading at these lofty valuations. So somebody is going to lose here. I just can't tell you who.
Yeah, or when is the thing. But you got to know it's going to be there. And again, I said by the end of the decade here, that's only 4 years away, $3 trillion more is going to be spent on AI. And there's still, and I think a week or two ago, we talked about how we're not really seeing the income from AI yet. So could that ever come?
Yeah, and I'll tell you that number might come down. I don't know if anything's going to happen on Monday but this is pretty big news to me. This just came up on CNBC. I had my computer pulled up. After previously boasting $1.4 trillion in infrastructure commitments, OpenAI is now telling investors that it plans to spend $600 billion by
less than half.
2030.
Wow.
Yeah, so that's a huge, huge change. And that still comes with OpenAI targeting about $280 billion in revenue in 2030. That's now just 4 years away. Right now, they reeled in $13.1 billion last year. So they really need to have this huge ramp up in revenue. They've obviously cut down that commitment level, which I think is going to hurt your Microsofts. They're a huge partner. We talked about her.
Yeah.
Other backlog, I think, is like 40% OpenAI or something crazy like that. That could be a big, big blow to Microsoft long term. And if, again, OpenAI can't ramp up revenue to $280 billion, they can't commit to spending $600 billion.
Well, and also, too, as you're talking, I'm thinking that this is really going to hurt the NVIDIA, the chip makers, because, well, wait a minute, you were going to spend, you said 1.4 billion?
1.4 trillion.
Trillion. Now it's going to be 600 billion. Well, a lot of that is in chips. And so this is where you get the, you keep adding and adding and adding. Eventually, the building collapses.
Yeah.
And I don't want to say that, oh, gosh, NVIDIA is going to go bankrupt.
No,
But that's not going to happen. But the thing is, eventually, it's not going to justify that high growth rate with that high PE multiple that they have.
Yeah. So I just continue to think, again, AI is just such a complicated space. It's here. It's not disappearing. Don't get me wrong. But the thing is, it's so hard to predict out what is going to happen here. And people have all their eggs in this basket, and things change. And all of a sudden, maybe a new entrant comes, or, I'm going to say maybe it is Microsoft that wins. Well, then that really hurts Alphabet, Amazon, Meta.
Yeah.
So, I mean, there is going to be a winner. I just can't tell you who.
And then where does Apple play? We don't even talk about Apple.
Oh, yeah, I got a whole load of thoughts on Apple, but I'll save that for another show.
Yeah. So, well, let's talk about some companies here. Again, we're going to cover DraftKings, Mattel, Ferrari, and restaurant brands. Let's kick off with a DraftKings. Their symbol is DKNG. The short on the float is a 7.5%, about 89% institutional owned. I'm surprised a little bit here. I thought they did have a PE ratio with earnings, but it says no PE ratio. So they have, at this point in time, no earnings. The industry does have a PE at 34. Price to sales, 1.8. That is better than the industry at 1.9. Price to book value, very expensive, 17.4 versus 3.9. And price to cash flow, also expensive at 16.7 versus 9.7. Now, the PEG ratio is very good. It's only 0.3 versus 3.5. So it shows you're paying a very low price for the future growth of this company. Unfortunately, earnings of last year, nothing there. The industry shows it was down 3.8%. Sales for DraftKings did increase over last year by 27%. That was above the industry, which actually declined 17%. And wow, this one I'm going to argue with, but I'll give the number now. The 5-year earnings per share growth estimate from the analysts is 67.2%, well above the industry at 12.8%. They do not pay a dividend. Their balance sheet looks pretty, their current ratio looks okay, 1 versus 1.4, but the debt to equity is high. It's 3. That is above the industry at 2.8, so a high debt industry, but I still don't like a lot of debt there. Intangible assets, about 55%. That's pretty high. Net profit margin is only 0.1%. That's not very good. Return on equity is negative 0.6%. Cash flow is okay, $508 million. Industry is about $612 million. What do you got earnings going forward?
Yeah, I was just looking at the company too. I mean, obviously, I kind of know them for their sports betting.
Yeah.
It says and I did see that they were going to kind of get into prediction markets as well to kind of compete in that realm. I don't know where that kind of stands in the process, but they also have iGaming or online casino products, which includes blackjack, roulette, baccarat, and slot machines. So I didn't know that they were also in, I guess, just the gambling. I knew they did the sports gambling, but the gambling, they do that too. Now, this is where things get interesting for DraftKings. The ticker symbol, again, DKNG, $22.31. 52-week range, low here, $21.01, and the high, $49.59. Year to date, the stock is down 35%. Over the last year, down about 55%. Last 5 years, it's down 63%. It looks like their high, was over $70 a share. Now, going forward for this business, We go out to December 2027. I see estimated earnings per share of $1.11. It gives us a target sell price of $18.43. So it still trades at expensive multiple. We'll call it about 20 times those future earnings. But this is to your point about the earnings growth. I have no clue how this is possible, but they didn't have earnings last year. They're looking for earnings now of 40 cents in 26, which would be growth of 3,900%. Then growth in 2027, 176%. Now, there's less analysts in 2028, but they're looking for 68% earnings growth. I mean, I don't know where all this expected earnings growth is coming from. But if I was a growth investor and this was actually accurate, I mean, that's a pretty good PEG ratio in terms of what you're paying for the earnings growth of that business.
Yeah, and the thing I look at too, you brought up the prediction markets, and again, you got two main players there, Kelsey, I think it is, and Poly Markets, the two that do it. Now, from my understanding, like Robinhood, the brokerage firm, they go through Kelsey to get the prediction markets. You can go directly to Kelsey. And I
Kalshi, yeah.
Well, how do you pronounce it?
I think it's Kalshi.
Kalshi, it's what, Kalsi or something.
Yeah.
I think there's an H in there somewhere, but
SHI.
SHI. But the thing is, you can go to them directly. Why would you go to DraftKings or why would you go to Robinhood and pay an extra premium for that when you get it directly? And again, I did test it out myself. So I was like, what is it all about? I was shocked to learn that you can use a credit card when you go to these prediction markets. I mean,
It's terrifying.
It's terrifying because you can't do that when you do investing. I don't think you can do it at DraftKings. I hope not. But that's a problem that's happening. We talked before about the CFTC, the Chicago Futures Trading Commission.
Is it Commodities Futures Trading Commission, not Chicago?
Could be, could be. So I think it's Chicago. I think it is Chicago. I think they cover it. Well, you look it up when I'm talking about it.
Commodity Futures Trading Commission.
Yep. But what I look at there is they got rid of like 12 attorneys. I mean, it's like the Wild West with this stuff, and people are going to get burned. And it was so easy to do. I did a trade. I've been on the Seattle Seahawks. I won $100 or something. Oh, great. But then I lost it predicting unemployment.
Inflation,
Inflation, that's what it was.
Was it going to come in above or below 2.4%? And it came in at 2.4%.
So I lost all the money that I won from the Super Bowl.
It's kind of like the roulette. That's how they get you, right? It's like, oh, you have a 50-50 shot because black or red.
Yeah.
But, oh, no, there's the green that throws in the odds and totally screws you over.
And I did it because I wanted to see what it was like. It is way too easy to do.
Oh, yeah. And I've never thought about that point. Why do you go to Robinhood, these other players, when Kalshi is the direct market? I don't know how it works.
And it was so easy. It's just an app. I was done in about 5 minutes. All right, so stay tuned. When we come back, we'll talk about Mattel, Ferrari, restaurant brands, and our financial planner, Harrison. He's coming up, so stay with us. Listen to Brent and Chase on the Smart Investing Show. We'll be right back. All righty, welcome back to the second half of the Smart Investing Show. This is when we talk about financial planning with our financial planner, Harrison Johnson of CFP. This topic here, we're not big fans of annuities. And you kind of ask the question, do commission-free annuities make annuities more attractive? So maybe we'll start selling annuities. Is that what you're saying?
So this is something that's been gaining popularity. It still makes up a very small percentage of all annuity sales. I think about 4% of annuity sales. But there are commission-free annuities out there. And some of the main issues that people have with annuities, including us, is there's a lot of internal fees in them, which can pull down performance. And there's the large commissions up front, which present a conflict of interest for the people that sell them. So they want to recommend things that earn a high commission, maybe not necessarily the best investment. So commission-free annuities attempt to address those two things. The person that sells them doesn't earn a commission, so that reduces any conflict of interest they might have. And since they're not earning a commission, the insurance companies that sponsor these things don't have to have as many fees, internal fees in the annuities themselves. So, on its face value, this looks like it could be, a better way to buy an annuity if that's something that you wanted to do. However, these types of annuities are generally sold by advisors that charge a fee for their service. So while the annuity itself might not have as much, fees going on inside of it, in addition to that, you generally now are also paying a fee to the advisor on an ongoing basis who sold that. So really, the performance, when you factor in the fee that you're paying to the advisor in the terms of like a management fee, they really come out to be very similar to traditional annuities.
And it's so funny you brought this up because just this past week I was approached by an insurance company about this. Like, oh, we got for advisors, no fee annuities, no surrender charge. Oh, okay, because I was thinking, if these are fixed annuities, maybe because we're sitting on about $100 million in cash. Suppose they're using the money market at 3.5%. Maybe we'll get a short-term annuity for like 4%, and we can sell anytime we want to. Well, kind of dance with the guy. He's trying to sell me something. I go, no, this is what we want. Well, let me have this guy call you back. Guy calls me back. Oh, well, it's a variable annuity. I don't want a variable annuity. We do the investment part. So they're so salesy, and they try to avoid the question. And it's like, I still don't think this is a good idea either because
I
you
don't
bring
think
up
I
the
don't
fees.
either. Yeah, I don't either. And I mean, I don't necessarily, as a consumer sitting on the side of, an investor, I don't have a problem with whoever I'm working with making money if I get the value out of that thing that I had purchased. But the main problem that I have with annuities, whether it's commission free or with commissions, is the underlying return, the return that you experience as an investor just isn't very good. If it had a great return and someone earns a commission, great, good for you.
Right.
But the way that it actually works, you just don't make a lot of money. And there's a lot of smoke and mirrors to make it look like you're making money investing in these things, but you're actually not. The income base grows at 8% a year. There's a 30% bonus that you get, guaranteed income. So annuities have guarantees, but the cost of those guarantees is low performance, essentially.
Well, I think it is interesting. 'Cause I saw this article that kind of addressed this as well, and I think it was like a Jackson annuity or something.
That's the one that called me, Jackson.
They're one of
Jackson
the
Life.
bigger ones, yeah.
But what they were saying was the commission-free annuity came with like 0.5% less per year in fees.
Mm-hmm.
But the issue is if an advisor, let's say, now is charging you 1% to manage this annuity, you'd be better off buying the commission-based annuity because you would have made, 0.5% more. So it just, to me, it comes down to buying good quality investments, not playing games with contracts. That's all an annuity is a contract, and understanding how that works. They're just so overly complicated in the long term that most people don't understand them, and it costs them in the long run. I talked to this lady last week, and she had an annuity for the last, I think, 9 years, and she has a 10-year surrender schedule, and during the last 9 years, she's made 12% total.
Not per year.
Not per year.
Total.
12% total.
Well,
and
wait.
she's still locked into that annuity.
That's more than 1% per year. That's not a bad
pretty
deal, right?
awesome. And it just, Harrison, you made this point before. You look at more annuities than I do. We have never seen an annuity like, wow, that actually worked out pretty well.
Yeah.
I have not seen one yet.
Yeah, I would love to see one because, again, if it made sense, it's all just about the numbers. If it makes sense, great. I'll buy one myself and I'll recommend them to people. I still don't sell anything or earn commissions on anything, but if something made sense, then let's go ahead and do it. But when you look at what's actually happening, okay, you're buying this annuity, so you're giving money to the insurance company, and then you are, accruing value inside of this thing, and then ultimately you get money back in the terms of, surrendering it and do something else with the money, or you're getting guaranteed income. But when you look at the guaranteed income in the form of that cash flow over the rest of your life relative to the payment that you bought initially, the internal rate of return of that is generally negative to, 2-3% per year at best, which, I don't know, that doesn't get me excited.
So after all your research, what you're saying is that these commission-free annuities still don't make sense. We still don't like annuities because they're smoke and mirrors.
There's smoke and mirrors, and insurance companies sell these things to make money. They have to make profit. And the reason why annuities are so complex is, one of the reasons why they're so complex is it allows an agent to kind of try and highlight benefits that you don't fully understand, and so that allows them to be sold, and the insurance company makes money. But every insurance company has annuities that work a little bit differently, different cap rates, different participation rates, different bonuses, different income withdrawal periods. All these things are different, but it always kind of works out to a very similar internal rate of return on the actual product, no matter what carrier you go with. And so this is the same type of thing. Well, it's not gonna be commission based, but there's gonna be other fees that now you're paying an insurance company and advisor. So the net result for you is gonna be very similar at the end of the day.
Right. So
And I would almost say, in some cases, as I said, these are worse if you have an advisor than if you just would have bought it through a broker.
yeah, and this is why again you want a fee-based advisor like yourself that is going to give you the straight information, not try to sneak in a commission there and say, oh, there's no fees, no surrender charge, don't worry about it. No, there's always something there.
There's always something.
Yeah. Well, Harrison, thank you very much. Appreciate it.
Thanks, guys.
Again, that's Harrison Johnson. He is our financial planner. He is a CFP here at Wilsey Asset Management. He is a fee-based planner. If you want to talk to him, give him a call. You know, I wonder if anybody listens to our radio show or podcast and they still go out and buy an annuity. What do you think?
Maybe.
Good salespeople out there.
Yeah, I mean, I just, yeah, I get the bonus. Okay. It's just, again, they're giving you, it's fake money, basically.
Yeah.
I mean, it's a contract. It's not an investment. And it just, gosh, it just drives me crazy
And
when I
then
see people and they get sucked into it and they hear all the great things. And then it's like, most people are like, oh, I know I shouldn't do an annuity. And then why are people doing it? I don't know.
People still do. We do have people we talk to like, oh, I would never buy an annuity. Good. People are starting to learn. So, all right. Well, let's move on and talk about our next company here for investment. And that company is Mattel, the toy maker. I'm sure you've heard of this company. This company, I think, going to give us some numbers, but I think they've dropped a lot recently. The company Mattel, their symbol is MAT. They're in the industry of leisure. I thought there was a toy category, but I guess not. Short is about 6.4% on the float side there. We do have a decent start here. The PE ratio 14.1. This is the last 12 months, well below the industry at 51.9. Price of sales 1.1 versus 2.5. Price to book value also good, 2.4 versus 3.4. And then price to cash flow 9.5 versus 14.3. So all the valuation ratios are lower than the industry average, but there's no PEG ratio, which is important because that's your price earnings divided by growth, tells you how much you're paying for the future growth of the company. Now, unfortunately, over the last year, the earnings were down 16.5% from Mattel, but the industry was down 40.1%. I wonder if that's from the tariffs or what's going on there. Sales did decline by 2.8% from Mattel, but they were up 4% for the industry. The 5-year earnings per share growth estimate for the analysts show that they're looking for a decline of 13.4% per year on the earnings. The industry is about flat at negative 0.1%. They do pay, no, they do not. They used to pay a nice juicy dividend. I see they cut that dividend. There's no dividend any longer on Mattel. They used to have a nice 4 or 5% dividend, but I think they're really struggling here. So no dividend there. Let's look at the balance sheet here. Current ratio 1.6 versus 2.5. That's okay. Debt to equity 1.2 versus 1.3. That's okay as well. We do see a net profit margin of 8.3 versus 4.2. Return on equity is pretty good, 19.1 versus 15.8. And the free cash flow is $488 million versus $623 million for the industry. Jace, what do you got going forward?
But that dividend point, it's actually been years.
Has
since
it really?
Yeah, they cut the dividend back in 2017.
Wow.
Yeah.
See, when you get to my age, it seems like 2017 was just last year.
And it's crazy because in 2016, they were paying 38 cents a quarter. I mean, just based off the current price, that would be about an 8.7% yield. Yeah. They did cut it to 15 cents in 2017, and it looks like then they fully cut it. And when you look at Mattel, I mean, the main brands that you're going to recognize is Barbie and Hot Wheels. And I know my nephew loves Hot Wheels. And actually, my daughter, she likes cars too. So, I mean,
but she doesn't like Barbies, does she?
She likes dolls. Yeah, I mean, she'll
the
be
Barbie
two.
doll.
We haven't gotten her a Barbie yet. We just got a little play doll. And then they do have like Fisher Price. It looks like another one. So they have the baby toys as well. Fisher Price is pretty big in that space. So, I mean, it's great brand names. I like what the business does. And I also am intrigued because the return on the stock has just been terrible. And it could be a buying opportunity, is why I say that. Current price here, $17.41, 52-week range. I mean, the low, $13.95, and the high, $22.48. Year-to-date, the stock is down 12%. Over the last year, it's down 20%. Last 5 years, you just made no money, down 10% during that time period. And the last 10 years is where things get dicey, down 46%. Over the last 10 years, as the stock was over $30 a share back then.
No, and this is a good example of why not to fall in love with a company.
And actually, you go back more than 10 years. I mean, gosh, this stock was over $45 a share back in like 2013.
Wow.
So definitely some changes to this business. But going forward, this is, I'm going to say, intriguing. You go out to December 2027, estimated earnings per share here, $1.54, gives a target sell price of $25.56. The stock is trading for about 11 times those future earnings. That is interesting. And the thing you look at is Hasbro, their competitor. That stock has just taken off as of late. But a big reason is they have this thing called Magic, which is like a card game. So in my mind, it's a totally different type of toy than what Mattel sells. I don't know, kids' toys, are they just not doing well? I mean, what's going on here is, phones and video games, is that just really taken away from kids' imaginations and playing with these kinds of toys? I don't know.
I think so. And this is just no research behind this, but I do believe that now kids, when they were younger, like 20 years ago, a kid would play with toys to maybe 7, 8 years old, 9 years old. I think now that is cutting sooner.
Yeah.
Maybe it's 6 or 7. So kids don't buy toys when they're 10 years old any longer. They have the cell phones, they have the video games, and I don't have kids that age, and you'll have a few more years before we get that. But that's just my feeling based on what I see from other kids.
Yeah, I mean, it could be, yeah, because you could have had, I remember playing with Hot Wheels, I think, until I was,
Yeah.
I wasn't 15 playing with Hot Wheels. I know that, but
That's not saying you're a nerd,
right? I think you're probably like 5, 6, 7, maybe. Like,
I mean, 20 years ago, I think it was even 10.
that was what you do, yeah.
Because you didn't have a phone, you had nothing else, so you'd have toys, and you had the little figures, the
Batman,
Power
Batman,
Rangers, all those, you had those.
Yeah.
And, I mean, I'm not around a lot of kids, but I don't see those toys much anymore.
Yeah, you used to play with your G.I. Joes, and
Yeah.
and it's kind of shifted away from imagination to, again, creation of videos.
Yeah. and I just, and again, you'd have to do some research on here. I just don't trust that $1.58 for December 2027.
I'm at $1.54, but
Okay.
give me that.
Yeah, Seeking Alpha, Stock Rover shows $1.58. So,
Yeah.
But yeah, what did you finish?
Yeah.
Okay, so what was the target sell price?
The target sell price on this was good, $25.56. I mean, we might have differing opinions. I like it. I think there's some potential here. It might be because I have kids and I'm thinking, maybe. But again, living in that space, I would need to kind of do a little bit more research on the broader population. But to me, I'm like, oh yeah, we just bought some Fisher Price toys. So.
Yeah, and again, I guess you have to understand the business more. But again, you talked about that 10-year return. It's still a negative 40%. I just don't know how they come out of this. They've cut the dividend. Something is going on with this business that is not good.
We bought companies before, though, that have had negative 50% returns over 10 years. And we're like, wow, this is great value. And again, because you don't need it to go back up 100% to make money.
No.
If it goes up to, even our target sell price of $25 a share, I mean, shoot, that's a good return here of, almost 50%.
Now, if they get some royalties or something from video games or something like that, I'd say, yeah, this could be good. But I just don't know the business well enough. And this is why, again, we talk about spending 10, 20 hours before you invest in the company. You got to understand what their business is, because it could be a dead money for years based on what they got going on. So,
I wish they paid a dividend. If they paid a dividend, I think I'd be more interested.
okay. Well, let's switch from little cars and little toys to big cars and talk about Ferrari with their symbol, race. I don't know how they got that symbol. That was quite the symbol there.
Probably because they're really into race cars.
Well, yeah, they're into race cars, but I can't believe it wasn't taken already by somebody. But they are in the industry of auto manufacturers. Float on the short side is only 3.4%. Their PE ratio is 34.5, which is high, but this industry is very high at 124. Auto manufacturers, I guess maybe that's from Tesla or something. I think they're in that.
I
industry.
assume so. I mean, Tesla's PE is like 200 now, so it has to bring up the whole industry average.
Yeah. Price of sales 7.7 versus 1. Price to book value 14.5 versus 1.8. Price to cash flow also expensive, 23.7 versus 12.3. Not only do you pay $250,000, $300,000 for a car, that's very expensive. You're paying a lot for this stock. The PEG ratio is good, 2.2 versus 4.2. Now, the earnings, nothing phenomenal here. Last year, they were up 6%. The industry was down 25.1. I think a lot because of Tesla, but still 6% growth on the earnings. That's not that great for what you're paying for. Sales, same thing. Sales are up 6% versus a 0.7 for the industry. Now, the 5-year growth rate, they do get 17%. That's slightly below the industry at 22.1. Why? They do pay a dividend of 0.9%, using a third of their earnings to pay that out. I don't know why they pay the 0.9%. I guess not too bad, 1%. We do see on the balance sheet, let's take a look here. Current ratio, 1.8, same as industry. Debt to equity, 0.8 versus 0.5 for the industry. So the balance sheet looks pretty good on the debt and the liquidity side. We do see a net profit margin. Here is the big thing with Ferrari. 22.6% people will pay up for those Ferraris. So for every $100,000 you spend on a Ferrari, the company makes about $23,000 off of that Ferrari. So $300,000 Ferrari. Gosh, Ferrari's making about $70,000 off of that Ferrari. Wow, no wonder they look pretty good. Return on equity is also good, 42.4 versus 6.1. Cash flow, now this is disappointing. It's only $1.5 billion. I say only because the industry's at 3.4. Again, gotta blame Tesla for this.
Yeah, and I do know that I did look it up real quick. Tesla's PE is 200 right now.
There we go.
So that is, again, going to have a big impact on the industry average, especially when other ones are at like 8, 10. Tesla's 200. But looking at the current price here for Ferrari, again, as you said, great ticker symbol, RACE, RACE. Current price is at $366.95. 52-week range. The low here is $328 and the high $519.10. Year to date, the stock is about flat. Over the last 1 year, though, down about 27%. 5-year return, 86%, and 10 years. I mean, this has been a great run here. 852% over that time period. Going forward, though, for the company, go out to December 2027, estimated earnings per share, $12.52. You get a target sell price of $207.83. Still trading around a multiple of 30 times those future earnings. And I'm going to say that the earnings growth is not great. We're looking at about 8-9% earnings growth over the next couple of years per year. To be garnering a 30 times multiple, I would want to be seeing 15-20% earnings growth, not 8.
And I got worse news for you. I mean, you showed how much of the earnings?
$12.52.
Okay, well, Stock Rover shows of 12 analysts, 1063.
Oh, wow.
So not even as good. And that is down from 90 days ago when it was at $11 a share. So I just worry because the high-end market, we've seen the high-end purses, the designers really getting hit hard. The economy's slowing down. You got a situation with China. I know China's a big buyer of Ferrari. It just doesn't seem to pay up for these luxury brands at this point in time.
Well, and the other concern I have with Ferrari, I mean, you talk about these luxury purse brands, right? They had this model of being the kind of like cream of the crop and, only the elite could get it. So they drive these high prices. Well, then they kind of lowered that threshold and that kind of alienated a lot of their consumers. Ferrari, I know, kind of did the same thing where they have their high-end car, but they, it's funny. It's not really your average day consumer, but they tried to create more of a economic model where, it's not as that exclusive as a product as it was. And I'm curious if it's going to play out similarly to these handbags where it's like, well, I don't want the Ferrari now because anybody can get a Ferrari. Anybody, more people can get a Ferrari.
Right. And I think the low-end Ferrari is still about $250,000. So it's not like the
But
purses.
they're producing a lot more of them than they were of the other Ferraris.
Yeah. And again, they could hurt their own market, and that's what happened to the luxury purses. They hurt their own market by doing that.
And it's a more extreme. But again, if you were part of an exclusive club of only I don't know the exact numbers for Ferrari, but let's say 10,000 people that had it, but now 100,000 people had it, and that's probably an extreme. It kind of really hurts and tarnishes that brand image.
Yeah, because you're paying up to have the exclusivity. Like, I got a Ferrari, nobody else does. So, and also too, I think a big competitor for them, Lamborghini. I think Lamborghini is much better priced.
Well, you're biased in that.
All right, so I got a Lamborghini. All right.
And the other thing I was going to say about Ferrari too is that the EV rollout has been pretty interesting. We got to see the interior of the EV. We still don't know what the exterior looks like, and I still don't know if people are going to want to buy an EV Ferrari. So we'll see.
I'm pretty sure that Lamborghini said that's not working out well for them because people, they want to hear that engine. They want to feel the roar, and it's just not. You buy an EV for practicality. you're not buying a Ferrari and Lamborghini to be practical. You're doing it for the excitement, the thrill, the noise, and everything else. So we'll see.
EVs just drive me crazy though. That people be backing up. They need to like add like a siren or something to them because you can't hear them backing up. You're like, whoa, where'd you come from?
Well, Tesla has that weird like woo, that ghost noise I call it. Well, let's move on here. We're out of time. What's our last company here? Talking about restaurant brands because we did talk about the beef side. So let's see what that's going for the restaurants here. Restaurant brands, their symbol is, and it's Restaurant Brands International. It's QSR in the restaurant industry. Not much on the float side, short side, 3.6%. PE ratio, 26.2. That is below the industry at 33. Price to sales, 3.3 versus 2.4. Price to book value does look good, 6.6 versus 16.1. And price to cash flow, 18.4, just slightly above 17 for the industry. And they do not have a PEG ratio, unfortunately. Now, we do see over the last year, the earnings for restaurant brands is down 11.3%, but yet the industry was up 5.8%. Sales were up 11.8% for restaurant brands, but down 3.4% for the industry. Analysts don't seem to like this going forward. The 5-year earnings per share growth estimate, a negative 0.3%, but yet the industry is a positive 9.7%. You do get a nice dividend, 3.8%. They use about 86% of their earnings to pay that out. That's a little bit high for me, but still a decent dividend. Look at the balance sheet, current ratio 1.1, same as the industry. That's good. But debt to equity, not so good, 4.7. That's well above where you feel comfortable versus 1 for the industry. So I will check if I can here the balance sheet to see if they have a lot of debt or just low equity. A lot of intangible assets, 67% versus 15.9. Net profit margin is 10 versus 7.7. Return to equity, very good. Tell me maybe a low equity, 27.3. Free cash flow, 1.4 billion. That's below the industry at 3.2 billion. A lot of stuff there. Not too excited about it. What do you got going forward?
Yeah, and I'm sure it's kind of like McDonald's and the other fast food restaurants where it's a franchise model is how they're going to be operating, which kind of distorts the balance sheet a little bit. What we call asset-light businesses. Give you an idea, too. You might hear the restaurant brand's name. What is it? You're going to recognize these companies. Burger King. Mm-hmm. Another big one is Popeyes. The other ones that they have is Tim Hortons. Not as familiar with that. And Firehouse Subs. I used to see that when I was in Arizona. I don't really know of any Firehouse Subs around here, but the big ones that obviously I recognize here in San Diego is going to be Popeyes and Burger King. But looking at the current price for restaurant brands, again, their ticker symbol QSR, $68.82. 52-week range here, not bad. The low, $58.71, and the high, $73.70. Year-to-date, the stock is about flat. Over the last 1 year, it's up about 9%. Last 5 years, haven't made much money, though, about 13%. 10-year return, not bad, up 100%, not including the dividend yield there as well. Going forward, though, for restaurant brands, we go out to December 2027. Estimated earnings per share, $4.38, gives us a target sell price here, $72.71. So it would be in our hold category at this time based off the valuation.
And they do have a lot of debt. I did look at the balance sheet here. They do have about $16 billion in debt on the balance sheet, which is pretty high. And I think I saw also two intangible assets were pretty high as well.
The other thing that I bring up with the debt, though, is that includes leases. I don't always view that as bad debt, right? If you have like a 10-year lease, I almost view that more as an expense than debt because it's just kind of part of your operating expenditures. But that is one thing I'd want to understand as well.
And a lot of goodwill and intangible assets. Goodwill's $6.3 billion and intangible assets $11.3 billion. So very weak balance sheet. And again, I hear what you're saying about the leases, everything else, but still there's a lot of worrisome things on here. And good companies. I mean, I think you said Burger King. And,
I was talking to somebody this last week, and some of these fast food restaurants, I mean, they kind of scare me in terms of obviously the health perspective. And the reason people go to them is for value. And I was talking about McDonald's in particular. I'm sure these are similar, but McDonald's has like a $5 deal now where you get like a cheeseburger and 4 nuggets and I think maybe a soft drink as well. And you talk about the price of beef. How in the world are they profitable producing a cheeseburger and nuggets for $5? There's no way that's good for you.
Wait, you know what it is you go. I went to Carl's Jr. the other day because I forgot my lunch. Yep. So I went there and they go, "You want to supersize it?" Yeah, go ahead. So you go in there for that meal deal of $5. You want to supersize it? You get the big Coke. You get the yeah, go ahead and do that. So they probably make a bigger profit off of doing that. So it's getting people there to the store, kind of like a loss leader, to get you in there to buy more.
Yeah, I still just can't imagine that it's obviously.
And have you seen the pictures of the drive-through, the burgers? Gosh, they look so good.
Yeah, no, I actually haven't eaten fast food in quite a while.
Really?
Outside of In-N-Out, that's my problem too. In-N-Out is so good, and I don't feel as bad after eating it, and the prices are really fair in my mind. So it's like, gosh, I don't know. I feel like it's hard for me to go to any other fast food restaurant.
I would go to Jack in the Box. Jack in the Box is a favorite. I would even invest in Jack in the Box if it was on sale, but it's not.
Jack in the Box, I thought was on sale. It's just,
was it?
yeah, their balance sheet is a big question mark.
That's
though.
what it was. Yeah. But they're a pure place. All right, there's a closing bell. Thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, as always, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or visit the website, smartinvesting2000.com. Again, that's smartinvesting2000.com for more educational information. And don't forget to sign up for the newsletter there. It's right in the center of the page. A lot of great information there to help you out become a smart investor. Smartinvesting2000.com. Thanks for listening. We'll be back next week right here on the Smart Investing Show.